Every week, I speak to several federal employees who are moving their TSP balances into the G Fund, but very few are doing it with strategy. Most of them were just scared. So we thought, why not make a video on the best uses of the G Fund during a bear market like this one? Stick around for our thoughts, and remember, the full article link is in the description below. So the G Fund can be a great investment in your portfolio, but like every investment, there is a right way to use it and a wrong way. A few weeks ago, we made a video called How to Avoid the G Fund Trap. If you haven't seen that video this year, that's another one you have to watch. At the end of this video, you're gonna see a pop-up that has a clickable video that will take you directly to that one. So because of how volatile the markets have been this year, federal employees have looked to the G Fund as a safe refuge. But the G Fund serves a much greater purpose than just reducing volatility. Figuratively speaking, the G Fund is almost like a savings account on steroids. The returns are not very great, but they're better than what you can get at your bank. The thing is, when you're building a well-diversified portfolio, some parts of your portfolio need to have not great returning investments, while other ones are offering you healthy returns over time. Now, this applies to all age groups. Young, less young, even lesser young. It's critical that a healthy balance sheet starts with a good cash position depending on your needs. Now, you can have that cash sitting either in your portfolio investment accounts, or you can have them sitting in your bank, checking, or savings accounts as well. And the reason that you have to have cash is because everyone has short-term needs. And if we look at the markets are unpredictable and sometimes very volatile in short term. So the ratios between what kinds of investments in your portfolio, that's gonna depend. And guys, we have more videos like this coming out, being produced right now. So if you're not subscribed yet, I don't know why you're not. Click the subscribe button now before this video ends so that the next video that comes out will be right on your list. In true wealth management, the markets are a tool with which you can grow your investments so that they can support the rest of your lifestyle. Ergo, stock picking is out, so the most important thing becomes asset allocation. Now, this is simply just the mix of investments that make up your portfolio. Now, I know you thought we were talking about the G Fund. Just stick with me for a second. We're getting to how the G Fund applies. Some parts of your portfolio need to be conservative for your short-term needs so that you have the ability to quickly access. Further down the line, you're gonna need more and more money 5, 10, 15, 20, 25, 30 years from now. And that pile of money today needs to be growing so that it's big enough for you to get there. So where does the G Fund fit in all of this mix? Well, let's look at this graph together. Now, first, understand this graph is for illustration purposes only. We are not actually recommending that you do an allocation like this. When we think about our short-term needs, we just talked about how our portfolios has to have low volatility and conservative investments to help meet those short-term needs. This could be cash, this could be money markets, both of which can be solved by the G Fund. Remember, the G Fund is like an amped up savings bucket, so you can utilize the G Fund to help meet this need. So when we look here, this could be something like this section right here. Now, over time, this allocation might change. What would change this? Well, your life. Maybe you retired, maybe you're buying that sailboat, maybe you have health challenges, so maybe the markets are volatile. You might have to begin to increase your cash position, maybe adding another 3% to your cash position. Or if you want to use this cash position as the G Fund, that can be the G Fund in your overall portfolio. But maybe the year is extremely volatile, like this year. You may want to consider, depending of course what's happening in your life and where your cash balances are, maybe for you, you may need to have a higher position inside cash. Maybe you've got expenses that are coming up. Maybe you're going to be moving. But maybe you have two people in your household earning a really good living, whether one of you is a Fed and the other is a private sector, or both of you are well-earning Feds. So perhaps someone in that case might not need this whole section here. Your need for cash is dependent on your ability to access it. If markets are volatile, it's harder to tap into the cash. But if you have income generating, then maybe you don't need to go to your portfolio. But if you're already retired, perhaps you may consider having a bigger cash position if it's a year where markets are very volatile. Maybe some of this cash is already earmarked to be a down payment on a home. There's various different elements about your life that should be gearing the planning that you're doing. The idea is that if markets are volatile, like the bear market that we're in this year, and you need to have cash, you don't need to sell the other portfolio positions that maybe have gone down in value since the beginning of the year. The risk in needing that capital when markets go down is called sequence of returns risk. So while there's no real blanket answer for how much cash anyone should hold, there are some general rules that we can talk about. Under normal market conditions, family with one income to their household may want to consider somewhere between 4 to 6 months of their regular monthly expenses in a cash-like position. If you're a family with 2 incomes, you can take that number down slightly and look at somewhere between 3 to 4 months in a market like this. So again, the goal is to make sure you're covering the risk of needing money when markets go down, because when they go down, they're going to take the more aggressive investments with them, like your growth components. And you don't want to sell when they're down. Remember, buy low, sell high. Then you apply the next level of information. What kinds of things are coming up in our family? Are we repaving the front driveway for $10,000? Does the fence need to be replaced for another $15,000? Your 3 months of expenses now has 2 additional expenses that need to be filled. And here's where the rubber meets the road. If you're retired or you're coming to retirement soon, everything changes. Your cash needs are generally speaking going to be greater. Your portfolio's job has completely changed at this point. You're no longer contributing to it and supporting it. It is now supporting you. And in a volatile year like this, it's not uncommon to see somewhere between 12 to 16, sometimes even more months of cash reserves laid aside. And this is because you cannot be reasonably sure that within that time frame, the markets are going to have recovered to the place where they were before. And so having the cash in anticipation, it gives time for your portfolio to recover over time. So we talked about how the G Fund offers better returns than just cash at your bank. So naturally, the G Fund is a great place for your cash position, right? Maybe. It can be as long as you understand how TSP withdrawals work. You must remember that the TSP does not allow you to select only one fund in your TSP to take the money from. So essentially, this can make the whole strategy of holding cash on the side for volatile markets for use during those times completely useless. Because as you go into the TSP fund trying to use your cash for this period of volatility, the TSP is also going to sell your CS&I funds if you're holding those funds within. And by doing that, you are essentially making your losses permanent, especially if you're not able to reinvest more aggressively. Now you might say, okay, well, I'll just hold the G Fund in my TSP because that way I can just live from there and not have to worry about selling low investments. Yes, the problem is holding too much G Fund creates an issue where your portfolio is now not going to be growing fast enough to support you for the rest of your life. So one solution that has been very successful for our clients is to hold the cash position in the TSP, in the G Fund, and holding the rest of their portfolio under a different custodian that does not have the same kinds of restrictions. The other alternative is to just hold cash in your bank or in your savings accounts. The most important thing is that you have a plan ahead of time so that when you get to a year like this year, you're not scrambling trying to figure out what you're going to do. You know exactly how much cash you need, where it's going to be, which position it will take, and as well as the rest of your portfolio. And if you don't have a plan and you want to talk to a group of advisors that work specifically with federal employees, we do that. So we're going to put our website in the description below. Check that out. If you're interested, there's a contact box on there. Be in touch and we hope to see you next time.